Greetings, this is Keith Prather with the NCM Farm Equipment Demand Index update. And it's kind of interesting. We're trying to figure out really what's happening in the farming community. Incomes have been stretched over the last 2 years, and we got a huge farm incentive program that was paying out over the first half of this year. So we did see most farms, and I say most, a number of farms got anywhere between 125,000 and $250,000 in infusions. A lot of them had to use that cash to pay down debt from incurred in 2023 and 2024. And then we get into this year, and we're seeing really great growing conditions across most markets. We're seeing really good farm output, especially in some commodities. Corn, it sounds like we're getting a little some mixed signals, maybe a little bit with what the yield ultimately looks like, but we are getting some different signals overall. But anyway, that's worked to push commodity prices lower because we are concerned about more output, a better harvest, higher ending inventories, and what looks like maybe some trade-induced and tariff-induced pressures on U.S. exports of grains. We're still not seeing China pick up a lot of soybean purchases. They really haven't made any purchases this year, and so we're seeing some sluggishness there. Overall, the demand index, I guess maybe if we're looking for some silver linings, maybe what we can say is that it's starting to jog sideways here. So we're starting to see a little bit of flattening out in the index. In July, it came in at 61.6, down just a hair from 61.8 in June, but still above the May, generally in line with where we were the rest of the year. So we saw a little bit of jogging sideways in it. So that's a little bit positive. The equipment, the industrial production side of things, when we look at the OEMs and look at the OEMs in production, they're still trying to keep things very conservative. They know the farming community is still under a lot of pressure, and so we don't see a tremendous amount of output. It did revert back to near normal on a year-over-year basis, but 1.5% higher than we were last year, but still about, I'm sorry, 1.5% higher month over month, but a little bit lower year over year, still about 2.7% lower than where we were. But moving on, we've got a lot of different surveys out there. There's a lot of different things we can watch every month. I do love to go to the Purdue and CME Capital Investment Index. This gives us an idea of where farmer sentiment, where their heads are. And what we're seeing right now is, it's elevated overall. If we're really looking for the silver lining, we say, okay, it's elevated relative to where we have been since really the lockdown period, where there was a lot of panic about food and food shortages and everything, and so we saw the farming community, we saw the optimism surge right after the lockdown, and then it came right back down to normal. But right now we're running at about 53, which is down sharply over the last 30 days. So we don't like that drop. It's stronger than we've been in the 3-year range, for instance, but it's one of the sharpest drops that we've seen in quite a while. So we are concerned about that sentiment, and this comes on the heels of the tax bill. It comes on the heels of the bailout program that came earlier in the year, and so farmers are just really concerned still about what's happening with the trade environment and tariffs. And since we don't have a China deal specifically on the table yet, we're not seeing a lot of increases in Chinese purchases of U.S. ag. We also see a lot of countries out there that are really starting to increase their exports. They're starting to see really good bumper crops in some countries that do compete against U.S. grains. And so there's just a lot of concern out there. And then throw on top of that, as I said earlier, that we are seeing a much stronger harvest potential in the United States, especially when we look at corn and soybeans. The wheat harvest was pretty good, and so as we get the roving crop reports, as we see the sort of the national professional crop assessment overall, we're seeing a lot of uncertainty in that report. And let me give you, for instance, okay, corn conditions. When you look at corn right now, they look fantastic. Corn conditions look awesome. But there's a window over the next 30 to 60 days, depending on what happens with the weather. And if we start to get an early cold snap, a lot of farmers may be forced to go and harvest earlier than expected, and that would change yield rates. They think the yield rates may deteriorate once we actually start to see real harvest activity. Again, the corn looks fantastic now, based on what we see right now with our eyes, and as they sample it, it would look like it would be a phenomenal harvest with strong yields. But there are some things that could pull those yield rates down. Again, the moral of that little story is that based on current projections, it looks like we're going to have too much inventory coming into the market at the end of this season. But as we get into the harvest season, there is potential that those yield rates would start to fall and this sentiment index would go the other direction, right? It would start to get optimistic because they feel like with yield rates falling, commodity prices would start to come up. They can improve what they're going to get, for the marketable commodities this year, and that might improve sentiment enough that we start to see some spending. There's a lot in there. There's a lot packed in there. But again, through the end of July, we didn't like the sentiment indicator. Now we'll watch it again in August and September. Some of these reports, we're all listening to the same news reports, and as we start to hear those, maybe we'll start to see a little bit of a turnaround here. Production for machinery, then right now our models have it just absolutely flat. We don't see a lot of change. And typically, what this would be telling us is that there's not a massive demand indicator here that would really help us see this go the other direction. And so that's a little bit of a concern. This index has been performing very well for us, 97% accuracy, 6 months in advance. So over the next 6 months to the end of the year at least, and early into Q1, we're pretty consistent, pretty confident that it's just going to continue to jog sideways. Um, so the environment you got is the environment you're going to get. Now, the one thing I've said in a lot of the other videos, and you can go watch the macroeconomic video, we recorded it for the first time this month. We are seeing the potential for two Fed Reserve rate cuts, 1/4 point in September, maybe one in December. That will help with some of these short-term interest types of purchases. So mortgages and mortgage interest relief, it won't help on those necessarily, but it would help very quickly with equipment purchases. What would be a fantastic scenario is that we would see the Federal Reserve trim interest rates and the short-term borrowing costs come down. And at the same time, the 10-year US Treasury, the bond market, would see some similar deceleration. And if that happens, then a lot of farmers can go out and refinance some of their mortgages, and then you'll start to see them have more monthly wherewithal to go take on some more borrowing, and you might see some more movement there. It's not as pronounced as we see in some other markets and some other big ticket purchase areas, but in the farming community, you will get a little bit of a boost if that does happen. So overall, don't need to talk much about the general economy. The general economy is kind of jogging sideways on us as well. So we are getting the same economic indicators across many metrics. The unemployment rate in the U.S. doesn't change much. It still stays sort of range bound in this 4.2 to 4.3% range, which is historically very low. Inflation looks like right now we're getting some pretty good signals that inflation could be pretty tame, maybe running 2.7% on the high side. But the Federal Reserve has it coming down very quickly, right back into this 2.4% range, maybe by the end of the year, definitely early into 2026. So that's why we think we'll get two Fed rate cuts and then maybe at least one, maybe two next year as we get a little bit deeper into the year. So that's what we had for you this month. Again, I'm really hoping I can get some better sentiment overall. I'm really going to watch the Purdue and the CME index, along with some of the other news that we're getting out of other parts of the economy, to hope we see some improvement and see a little bit of an uptick in the overall farmer sentiment and their ability to go spend. We didn't talk about the tax bill this month. We did last month, but there are going to be some tax incentives and tax savings, especially for purchases under $2.5 million. So those incentives are still out there. So as soon as we see a little bit of farm sentiment improvement, you will start to see a little bit of a hike in spending, especially once they realize they can depreciate some of those bigger ticket purchases. So again, let's hope. Here's hopium moving forward into the rest of the year and early into next year. But again, we got to go on something. So I'm going to go with a little bit of hope here. So, all right. Hope everyone does well. Take care, and we'll see you in about 30 days. All right. Take care.